Welcome to Small Practice Support Information Session number 30. In this Law Society of Ireland recording, Michael O'Scahill talks to Justin Purcell about legal firm finances.
Likely to see a lot of those. So agility in your business planning is going to be important, and in setting your financial goals. In terms of key challenges, I suppose what we would say is don't just consider your practice, your professional practice. Also have a look at yourself personally. Obviously, for your practice, cash flow, profitability, and investment are going to be your three big challenges. Managing your cash flow throughout the pandemic era, improving your profitability gradually, and allowing you then, in conjunction with your investment, to take advantage when we get liftoff, hopefully later in the year. And on your own financial planning, I think it's always good to take stock and to look at things like your savings, your plans for those. Should you pay down debt, for example? Pension planning, keep that on the radar. Don't kind of park all those things just because we're in a challenging year. Always keep an open mind. If we look at, I suppose, the first area then that we said was important, which is profitability. And this is a challenge not just in COVID times, but in normal times as well. So I guess over the last 12 months, what we've seen a lot of, and it's understandable in a sense, we've seen a lot of people focusing on the cost element and controlling costs and bringing them down. And that is obviously one side of the profitability equation, and it's important. And again, as I said, be wary, because currently with various government supports, whether it be the various, the EWSS wage subsidy scheme, or rate waivers, or even, revenue debts that have been parked and on which you don't have to pay interest, your costs potentially could be a little bit artificially low, and your cash balances could be artificially high. So be wary of any shock or culture shock as those schemes are withdrawn. So cost management, absolutely always important. But it's also important to look at the other side of the equation. In other words, income, turnover, sales, getting client work in. And we'll talk about that in more detail in a few minutes. When we look particularly at the COVID era, some of the key objectives or challenges as you navigate COVID-19, and winning new work is there. Again, as I said, new client work, which we'll talk about in a minute. But the other aspects that are particularly important in the current period would be maintaining your financial discipline. So doing the simple things well and doing them right. So things like keeping your WIP under control, being ruthless, writing off any WIP that's just not going to be recoverable, trying to minimize, I suppose, within reason, the irrecoverable WIP. But again, obviously, in the era that we're working in, there will be inefficiencies there. So you're going to unfortunately have to take a bath on some of that. Looking to collect or to bill WIP early, as early as possible. Get your bills out. Go after your cash collections to get the money in. And as we said, keep your costs under review as well. So financial discipline, doing the simple things right and doing them well. The last 2 points there, I think, under the key objectives, kind of what we might call practice management issues that will impact on efficiency and, by extension, profitability in the current period, being in the areas of staff and IT. And in the area of staff, obviously, particularly say with legal practice, I suppose a lot of it is remote working, or has been since last March, at least on and off to a large extent. People will say that overall, maybe, I'm sure there'll be a book written on this in due course, but a lot of people say, well, we've adapted to it. It's actually working out well. My God, shouldn't we have done this all along? But there are also challenges there. And I think one of the issues we've found, and it's maybe a little bit topical with all the talk this week of homeschooling and kids, learning online, and whether it's the right thing or not, is we probably find there's, the accountancy profession is probably the same with the legal profession, that the senior or experienced staff probably can adapt to this. But your younger, less experienced staff, apprentices, trainees, etc., typically they're the people maybe who need the hands-on support. So it's important, it's more challenging for them perhaps. So it's important with those staff probably to keep up your training with them. And as we now know, we have a wonderful array of online facilities and systems that can be used. And so it's important to keep up the training with them as much as possible, acknowledging that it is a challenge for those younger or less experienced staff members. More generally across the staff base, I suppose the danger is that there's an element of isolation there, to become detached or don't feel as involved. So simple things like having your team meetings, even occasional one-on-ones, to check in with them, see how they're getting on, try and create some sort of an office vibe, albeit remotely. You won't have the water cooler moments as they're known, but within reason, you can drum up, you know, at least avoid that element of or minimize that element of detachment. On the technology side, I said at the outset that people would have looked at you askance this day last year if you suggested some of the things we're now getting used to. But equally, I think this time last year, some of the technology that we're now using, I think many of us probably either wouldn't have been aware of its potential utilization, or dare I say it, in some cases might not have been aware of the existence even. And yet we've adapted to this, and look at the use we're making of it now. And there's a lesson in that, because I think a lot of people are now looking and saying, gosh, should I invest in new technology and new gizmos and all this kind of stuff? But maybe you should pause and say, well, hold on a minute. This time last year, I had this technology, or it was there, and I wasn't actually using it. And now look at all the use I'm making of it. And there are people out there, IT experts, who say that even now we're only using maybe a quarter or less of what we could be using. So before you jump into big investments in IT, consider, are you making best use of what you already have? Looking at the bigger picture and kind of client wins and all this, and God, you could run a day-long seminar probably on this with all sorts of input from people. But broadly speaking, if you're looking to grow, I suppose your choice essentially is that you either go into new markets. So you either say, look, I have my product offering, but there are new geographical markets or new industry sectors that I'm not strong in, and I really go after them and I'll pick up new clients. Or you could look at your existing client base and saying, I've got great clients at the moment, I'm doing good work with them, but I actually have services already on that I offer that a lot of my clients aren't aware of, or that they're not availing of. So I'll try and target them with those. Or there are new services that I could develop, new specialisms, and I'll be able to offer those to my existing client base. Or you could simply say, look, I'm going to focus on my existing markets, my existing service offering, but I'm going to try and win new clients within what I'm doing already, without necessarily having to go into new markets or sectors. So market penetration, as it's known. And you're essentially trying to be competitive against your competitors and beat them to work. And we'll see in a minute as to how your existing clients might be a help in that regard. The other issue to look at is when you're making these decisions is, I suppose, maybe a little bit highfalutin here, but your market strategy. What do you regard your firm as? Are you a niche firm that has a differentiated product offering or service offering? Or are you a standard firm, that's offering the normal range of services, in which case, and most firms are, we all, I think we're a little bit different, I suppose, but most firms do come into that standard category. And the critical thing there is that you're able to offer the quality of service at the best price. Otherwise your competitors will quickly outstrip you. So all of those kind of feed in. Just some observations there. I mentioned about market penetration and getting new clients within your existing service offering and within your existing markets. Like, your existing clients can be they can obviously be a source of additional work for you if you're offering the additional services. But if you're staying within what you're doing already, referrals. So work with your clients, because if you've built up strong relationship either with your existing clients or your existing contacts or people that you do work with, they can be a source. Of try and get referrals from them, and that does take time. You need to build relationships, the trust, etc. But eventually, they can be a source of referrals. I appreciate in the current environment, with physical restrictions, that it's difficult maybe to network to the same extent. But your existing client base there, sometimes it's a little bit of an untapped reservoir, either in terms of new work that they can drum up for you themselves, or that area of referrals. And the other point to note is billing and pricing jobs and so on. So timesheets, obviously, may be unpopular in many cases, but unfortunately they are the staple of accountancy and legal professions. And the key thing is to make the right use of them. So they're not necessarily they're not a competition as such to measure people against one another. And unfortunately, sometimes that's the way they get used. What you use your timesheets for is you use them to work out how much the job is costing you to deliver. Now, your pricing strategy, you might have to tweak it from client to client in terms of how you agree fees, but you do need to be conscious and aware of what you're doing. So important that the time is recorded accurately, that proper narratives are put in as to what you're actually doing, so you get a proper feel for what jobs are costing you, so that you can then go and quote accordingly for a new job that comes in, and bill accordingly. And bear in mind that you have only a certain number of chargeable hours in the year. You have X number of fee earners who work whatever 37 whatever hours per week. You have to take out admin time, training time, CPD, all that kind of practice development, all that sort of time. So you only have a finite amount of chargeable hours to deliver enough fees to cover your overheads, your fixed costs, fixed and variable costs, and to deliver partner salary and ultimately profits. And therefore, if you give a discount to a client, if you underprice a job or you give a discount to a client, that's like taking the cream off the top of the cake, because you have to meet all of your costs anyway. So any loss in fee is coming straight off the profit. So a 10% reduction in a fee, discount or underpricing, could conceivably be a 40, 50% reduction in the profit margin on that job, because it's all coming off that top line, the bottom line, rather, at the top of the cake, you want to go another way.
Michael, if I might make a small point there, just on the time of the year, putting a budget together, like an annualized budget with regards to costs, and then potentially a cash flow projection, and then looking at that at an annual point of view, and then looking at it at a monthly basis. How important is that in reference also to the billing, putting a timesheet together and then be able to track that? So how many firms are actually doing that?
Yeah, well, yeah, probably more should be doing it. It is important, because ultimately, I suppose the critical thing here is that the timesheet, as we say, is essentially what measures a lot of your costs. I mean, your labor, if you like, or your human capital, and therefore it is absolutely important, because you need to sort of work out over the course of a year. You have an idea of what your overall costs are going to be. And there's almost an element there that you have a target in mind, which can be frightening at the times when you strip out all of the unavoidable non-chargeable time and all that sort of stuff, and you work out what your average fee, your average hourly collection has to be. And when you compare that sort of to your charge out rates, that gives you an idea as to the level of pricing that's required. In terms of annual versus monthly, obviously in the current environment, given the changes that are in place and the changed circumstances which we find ourselves, it's even more important to do that on a monthly or quarterly basis.
Yeah. So that really allows you to reference it each quarter, to go back and see where you are with regards to your billing, so your money's coming in and your outgoings. So I won't
absolutely. Because there is a concept, and we're all familiar with the concept of lockdown over the last 10 months, but there's a concept of lockup as well, which is the number of days it takes you from when a fee book is over and a client book or an instruction is opened to the point where the money hits your bank account. And, so that takes into account the actual work in progress time, the time spent doing the job to get the bill out, and the time you're waiting to be paid. And, if that's 120 days, that's 1/3 of the year effectively. If you can get that down, say, to 80 days, you've reduced that to whatever that works out at, 22% or whatever a year. So that's free cash coming in. Cash comes in 40 days earlier. It's in your bank account. That's money that you don't have to borrow. So you save the interest cost on it. So ultimately, this all matters. So it's important to keep a close eye on this.
Two great tips there. One is the pricing of the job, that if you can get that correct, and then the recovery of the costs on the job, i.e. completing the job sooner, means the money comes in faster. So that can have a multiplier effect on your cash flow, can't it?
It can indeed, absolutely, on cash flow, and in turn then on costs and profitability, by virtue of the fact that you save on financing costs. Cash is available to you, and then potentially more to reinvest and all that good stuff eventually. So it should all have a multiplier effect, absolutely. When you turn then, so that's your profitability. You then turn to cash management. There's an old saying there, I actually saw it yesterday, an interview with a business person, where he said, there's the old saying, turnover is vanity, profit is sanity, but cash is king. Now, this business person I saw yesterday said, turnover is vanity and profit is vanity as well, and cash is king. We all agree on that. So getting your money in is important. So debt collection, obviously. So you'd have strategies here, like have a clear responsibility for who's chasing debtors. So you might have a credit controller, but it's also important that the person who raised the fee, that the point of contact, if you will, plays a role in this as well. But clear responsibilities set out. Also in the current year, second point there, a big one, and can be difficult at times, stop work on non-paying clients. Now I appreciate at times of recession and economic challenges, and we all tend to, he's a great client, they're great, really good clients, we're going through a tough time, we'll support them now, and they'll come out the other end and we'll get the benefit long term. And certainly there can be merit in that, but be careful, because what you don't want to do is spend time working for nothing, and essentially the client then either goes out of business or disappears, So just be careful that you do have to have an element of ruthlessness there, that you prioritize clients who are actually going to pay you. Then also in the current era, should you be considering incentives for early payments? Should you even look at things like asking for either full or partial upfront payments for certain clients that you're concerned about? Probably is something you should be looking at. An observation I would make here as well is that, and it kind of ties in what I said earlier about how we might move from stage 1 to stage 2 to stage 3 and back to stage 1 again in terms of the business cycle and going back to kind of crisis management and so on, particularly when government supports are lifted. Currently in the economy, there's a lot of money in circulation because the government has obviously injected a lot of helicopter money, as it's known, in the form of things like EWSS, TWSS, COVID PUP, CRIS schemes, the various things. So you yourselves as professionals may have waivers of rates, for example, commercial rates. So yourselves as professionals may be availing of some of those. So you might have a nice handy cash flow balance at the moment. It might look good, but that could be artificial. Okay, when these supports are withdrawn, things might not be as good. And also in turn, your clients, they might be in a decent place cash flow wise. So they might be good payers at the moment, but they could run into difficulty later in the year. So the point here is, don't fall into complacency just because it's not a problem or an issue at the moment. Don't assume that. Just keep aggressively chasing down debts and make cash collection a priority. Just carry on as though you're still on the war footing.
Michael, just a quick question there on, sorry to cut over you, but it's in relation to the wage subsidy scheme and some of the other schemes that are available, that there was talk that these would be taxed, and somebody's asking that they haven't heard anything about these payments being taxed and what's happening.
Yeah, so the temporary wage subsidy scheme will be taxed, and it's kind of got a lot of attention in the media today, and people are saying like that back in the day, back in April, May, that maybe revenue were a bit coy about this, and they were to an extent. Now, it was known if you supposed to be working in the tax area at the time that they would be, and we could see kind of landmines coming down the line with this, but maybe the government and revenue weren't as candid. There will be tax bills. So PAY employees who got the wage subsidy scheme, the TWSS, this is the one that ran from March to August rather than the autumn on the EW scheme. The TWSS is going to give rise for most people to a tax liability of some description. And they're due to find out, what day today? It's 13th, isn't it? Friday. So the end of this week, they should get a notice in their revenue inbox. I was going to say Ross for PAY people, it's the revenue my account. They'll get a notice, a provisional liability as to what TWSS has given risen to. That tax will be payable. Revenue have said you can pay it up front if you want, or alternatively, you can pay it over by having your tax credits adjusted for up to 4 years, starting in January 2022, running from 22 up to the end of 25 effectively. Or they said there back in early December that if the employer wants to pay the tax bill arising for the employee, that they can do so without triggering a BIK charge. Normally, if an employer pays your tax bill for you, there's more tax on that because it's a benefit in kind. They say that to the extent that it relates to TWSS tax liabilities, they won't apply that BIK. And that's a question, obviously, do employers want to do that or not? I think the Irish Times had a fair point today, which is that indirectly, and maybe people didn't realize this at the time, but because of the way the TWSS scheme worked, it did actually constitute a form of pay cut for the employee, because the objective was to leave your net pay the same, but the way the scheme worked, it meant effectively your gross pay was cut. And that now is, this is payback time. This is where the employee will realize that there's been a cut. It comes in the form of the tax bill. So, but again, the employer, whether many employers will choose to pay it for them or not, but there is that facility there if they wish to, without triggering BIK. That's an important point. Other tax issues here on cash flow. We obviously have a heap of tax warehousing schemes on the go since last March, VAT and PAY originally. Then income tax warehousing was introduced in November, which might impact, say, sole partners or self-employed solicitors. There'll be another income tax warehousing scheme potentially available next November for income tax as well. Just be wary with all of these schemes that you're either availing of or have availed of, that, it's great in one sense, it helps the cash flow and so on, but the day will come when you'll have to pay them back. And even though revenue say they'll have a number of incentives or reduced interest installment arrangements and so on in place, you do want to be careful that you don't just have a big pile of tax debt at the end of it all. So maybe give consideration. Look, if you've got stuff in the warehouse, there's nothing stopping you paying some of it off. You have the luxury. They're banked there essentially at the zero rate, which is great. But from your own cash flow perspective, you might feel that it's desirable to start paying off some of them. So take that longer term picture there. Notwithstanding what I said about having to plan short term in the current crisis, an element of taking the bigger picture into account is appropriate there as well. Very practical point, we often bring this up on not just in the context of COVID-19, but if you have a small business where your turnover is less than €2 million per annum, you're allowed to account for VAT on the cash receipts basis instead of invoices. So if you're having difficulty getting people paying you, at least you won't be paying the VAT until you get the money in the door. So just consider that if you're not already on it. In addition to the various revenue schemes, there are other financing. Yeah.
My quick one on that one. When you change that, your VAT on the cash, can you do it by month or does it by annual?
Yeah, so cash receipts basis is typically it's when you're bi-monthly, but there's two aspects of VAT. You can choose to go on to an annual VAT return, but that entails paying a direct debit every month. So that could be completely unrelated to what you're collecting or invoicing. The idea when you go on the annual VAT return is that you make sure that at least 80% of your VAT bill is paid by direct debit. So it's your top up on the 23rd of January, 31 December year end, that your top up is no more than 20%. So you have a fixed direct debit every month. Now you can keep that under review. If you think business is declining, you can reduce the direct debit a couple of times a year and so on. But that's in itself, that's a separate scheme. So that's if you're on an annual return basis. You file one return typically on the 23rd of January each year for the previous calendar year, but you pay direct debits during the year, which must be at least in total equal to 80% of the final liability. The other option, though, is if you're on bi-monthly returns or indeed biannual returns or quarterly returns in some cases, the default position is that you account on an invoice basis. But if you have a turnover of less than €2 million per annum, you're allowed to do it on a cash receipts basis, which means that you pay over the VAT as the money comes in rather than as the invoices go out. Your VAT on purchases, though, you keep claiming them in the normal way when you receive the invoices from your suppliers and so on.
Thank you.
So it's a useful one to bear in mind. Other financing options, just bear in mind as well, like Revenue have these range of reliefs and supports, which are certainly very welcome, and zero rate is obviously fantastic. But also maybe look at the bigger picture, kind of looking a couple of years down the line, when eventually hopefully we're out of COVID-19 and all of this debt becomes repayable. There are other schemes out there at the moment, the SBCI, the Strategic Bank and so on, at reduced interest rates, government-backed loans, microfinance, that sort of stuff. Have a read up on those and familiarize yourself with those, because they could be useful sources of capital for your business as well. And then the final point there is consider literally the partners themselves making sacrifice, either deferring or reducing their partner distributions, or even in some cases investing capital. Because one of the ideas here is that the business will have sufficient capital, and both financial and human capital, for hopefully when the upswing comes, when we're out of all of this. Because I think I've often heard this. I remember back in the 08, 09, 10 crisis, people saying a lot of businesses, I don't want to bring up business failure necessarily, but a lot of businesses fail or run into difficulty, not during the recession itself, but in the aftermath, because they're not ready to take advantage of the uplift, and suddenly they get caught out and fall behind and run into their financial difficulties and so on. So it's important to be fit and lean and ready for the reopening. But another point I'd make as well there is that if you do some of the other things well, your debtor management, cash flow management, all the steps for profitability and so on, avail of the right reliefs, the right schemes, the right supports, hopefully you'll be in a good position. You won't have to, as partners, make some of those sacrifices to the same degree. So there's a bit of an incentive there as well for yourselves personally, which can kind of tie in then and enable you to do some more adventurous personal financial planning, which I think I mentioned at the outset there, on things like pensions and so on and that type of thing. Final point was to cover some accounting tips for lawyers, good old accountancy. And I think the last time I spoke with you, we may have touched on some of these back around the income tax deadline, as these can impact on taxes as well. I mean, bad debt provisions in the current era, if you're carrying debtors that you're not going to collect, it probably makes sense to take a bath on them and such, to be ruthless, go through your debtor ledger, identify, are there any there that you're not going to collect? And if there aren't, then maybe write them off. I mean, from a commercial point of view, that probably makes sense. or can make sense. But also from a taxation point of view, if you write off specific bad debts, it is deductible against your taxable profits and would therefore reduce your income tax. So if there are debtors there that aren't collectible, it's no point probably paying tax on them right now. If you're going to write them off in due course, okay, you'll get the write-off when you eventually, but maybe now is the time to look at that. And at least get a tax saving to assuage the pain of having to write some of them off. WIP, work in progress, is another one. This is a complex area, complex accounting rules and accounting standards to consider and so on. But essentially, work in progress and the way it's recognized in the accounts, the higher the work in progress in a given year, the higher will be your profit for the year, and therefore the higher will be your income tax bill. So within those parameters of the accounting rules and so on, it can be worth looking at doing a WIP exercise effectively. And if it's a case that your WIP this year would be lower and that it should only be recognized next year, okay, eventually it will be recognized as profit and therefore tax. But if you're pushing it out this year into next year, it does have the effect of deferring some of your tax payments for another 12 months, albeit that at the same time, you probably want to be conscious that you don't want to be showing a very bad profit figure or loss figure if you're looking for bank finance and so on. There's a bit of juggling there as well. And WIP as well kind of ties in with turnover, because the accounting rules here then start looking at what point does a balance get taken out of WIP and put into actually recognized as turnover. And turnover isn't necessarily the point that you raise your invoices or the point that you're paid or anything of that nature. It's actually an accounting concept, and it kind of relates to when the work is substantially done and is billable rather than when the bills are raised. So there can be differences there. And why is that important? That's important probably in the current context, and I know this is an issue that has arisen, I understand, from experience across the professions, is that some of the revenue subsidy schemes or support schemes have a turnover test applied to them. And there have been arguments over what exactly turnover is. I remember TWSS had this turnover test that you're going to be down 25%. I think for EWSS, it's 30%. So it's important to look at that, talk to your accountant in terms of what your proper turnover is. I mean, if you're doing management accounts monthly or quarterly, this thing probably will arise because that exercise will be done in any case. If you're not, well, then maybe you need to talk to your accountant and put in place some sort of a formula that will back it up, particularly if you're applying for any of these support schemes. So plenty of accounting issues there to keep us awake as well.
I think we're coming to the end there, Michael, of our time allotted. Is that your last slide, or?
It is indeed.
Yeah. So, listen, that's been a whirlwind of really good sort of thoughts on where we're at. I think the takeaways that you'd like people to take away. Well, I'd like people to do a budget and a cash flow projection, a 12-month one based on the months. What would you like people to do?
I think probably what I'd like to do is probably a lot of even the simple stuff there, put in place, have the right procedures in place, managing WIP and cash collections, but also some of the other practice management things that I mentioned, I think are important around particularly staffing and IT, but I'd say particularly staffing, because ultimately they're your biggest resource, your biggest capital source, if you will. And they're going to be important to you, not just now as you navigate COVID-19, but hopefully the light at the end of the tunnel when we come out of this, because you'll want to be able to hit the ground running and take advantage of the upswing. And therefore it's important to look after your staff in the meantime. And even those little practical things I was saying, like training, keep them trained, keep them upskilled. And even those little things like the little chats or the informal calls or team meetings and that as well. I think that's actually very important.
Listen, Michael, that's very good. Thank you very much for your time today. Listen, next week, Michael Mann is going to do a review of client case management systems, which will be able to improve our efficiencies and understand our WIP on a more continuous basis. So we're really looking forward to that. Thank you very much for your time. If you want to see any of our previous sessions, they're on the lawsociety.ie support webinars, and we look forward to you. Michael, you're actually going to be joining us again in 2 weeks' time on the 27th.
Yes.
To talk about merging or retiring from a practice. So we look forward to that too. So
I look forward
on
to
that
that
note,
Justin, yeah.
Thank you very much, and slán, everybody.
Slán.
And so hopefully we'll see you next week. Bye.